Now, our guest speaker today is Geoff Bysshe, who is the president and co-founder of Marketgauge. Geoff has 20 plus years of trading experience and is a former floor trader and hedge fund manager. He is also a published author of the book Trading the 10 O'Clock Bulls and has developed several popular trading courses and mentoring programs. And with that, please join me in welcoming our good friend Geoff Bysshe to the Trading Pub and his presentation today on the secret behind triple play indicators.
Wow, well, thank you very much, Raleigh. Before I do get started, can I just make sure that you all can hear me? So I've used Omnovia several times, so I am familiar with it. But let me just make sure I've got everything right. And I want to be able, so there, for example, now I switch to the chat. I see your answers. Great, great. So one other quick question I have. How many of you are brand new to a Marketgauge presentation? This is the first time you've heard anybody from Marketgauge give a presentation. If you're new, just say new or yes, that would be fine. We've got a lot of you here, so it'll scroll right up. If you all give me crazy answers, I won't be able to read them. And we'll have plenty of time for questions and stuff like that. As I go through, you can ask questions, but I do anticipate a detailed Q&A at the end. If I can work your questions in as I go, I will. But as you and a lot of you are new here, that's great. As the new ones will come to realize, if you get me off on a tangent, I will just keep talking. We'd never get to the end of this presentation. And this is really an exciting presentation for me for a couple reasons. One, because the whole secret and triple play indicators is exciting because I still get excited when I look at these things, even though I've been using them for years, because the secret or the magic behind these is their simplicity. And the fact that they are able to tell you really the three things you should know about every single trade that you enter. The other reason that this is exciting webinar is because of where we are in the markets right now. As you're going to learn, these indicators are all about finding the right place to be at the right time. And how many of you are currently trading stocks or ETFs? Because that is what we're going to focus on. So for those of you who are actively trading the market, I'm guessing that that's most of you. How do you, I'm just curious, how do you feel about the markets right now? I always ask this question, and I can tell you I get different answers based on what the market's been doing, but for 2015, I got the same answer: choppy, tough. Some people would say good if I write option premium. But what's your expectation? Okay, so I'm still seeing choppy, volatile, definitely volatile, exciting, that's good to see, nervous, that's good to see. Who wants to wait until the markets are safe to really start trading again? Anybody want to wait, or anybody want to get going right now with the markets just days away from the biggest crash? So how about wait or not? All right, great. I don't have any waiting. Oh, okay, couple waits. Not sure about direction. Yeah, that's okay. Honestly, I'm not sure about the direction either of the overall market, but what I do know is what I'm going to do with it. And so let's start. In part of the messaging that went out before this webinar, it was to let you know that we are going to talk about the markets as they are right now. So I'm going to start right now. I even took a screenshot of what I was looking at today and some of the trades that I was in. I didn't know that I would do that, but it worked out rather nicely. So we're looking at the SPYs right now. Here's a simple but very methodical approach to what to do next. Okay, so the moving averages that we're trading or looking at on the screen are simple moving averages. The green one is the 10, the magenta is the 50-day, and the gray one is the 200-day. Really basic. All right. Now, I'm not going to suggest that that this particular roadmap is the only way to look at the markets. But if you look at the markets like this, you have a new range that's been established here, a range that's been established here, and a range that's been established here. The 10-day moving average also provides kind of a line in the sand as to whether or not you might want to have a bullish or bearish bias. So as we come across the 10-day moving average, consolidate, it's going to be an indication that the market may want to go higher. And then if it breaks up higher, that's your first indication it wants to go higher, right? So even better if that kind of lines up with the 200. So for right now, I don't have to worry about which way the market's necessarily going. The big critical points are when it reaches one of these levels, passing through the 10, which it just did, but now we got to reach these levels. And then the next big points are going to be these moving averages, right? Now, so the question, and this is going to be true on each individual stocks, each individual stock. Can you guys hear me okay? Someone's asking me to turn up my volume. I've got it all the way up. So these are the same questions that we have on individual stocks. And who would agree that if you can catch stocks, one of the great ways to catch stocks or ETFs is when they either retrace to a major moving average or they come back through a moving average and a new trend emerges. Either the new trend is they hold the moving average on a retracement and then resume their major trend, which is going to be hard to find now that we've just collapsed, right? Or they've collapsed through the moving averages, which flushes out all the chickens and the bears, and then they start to move back up with fresh traders, right? Who would agree that those are great opportunities to find stocks that are about to really take off? I certainly think so. Obviously, a lot of you do too. So if you focus on these points, you can have some real control in your trading. And we're going to come back to that. So today, this wasn't really going to be part of the presentation, so it's going to seem a little quick here. But so this is what I was looking at today, at least one of my screens. I look at the intraday price action, and when I do, I look at the first 30 minutes of the day, high and low, and that gives me kind of a roadmap of which way the markets may want to go. Maybe you've seen this particular approach. We've done a lot of it. That's not what I'm going to talk about in this presentation, but that's why I have these red and green lines. So the green lines are the opening high, red line is the opening low, and so the SPYs today opened, consolidated for a little bit, and then headed higher. But unfortunately, they pulled back into the 30-minute opening range and then went all the way down to the low of the day, and then in fact broke below the low of the day. Fortunately, the prior day's high held it. Now the Qs, on the other hand, started off the same way in the morning and broke down the same way. Unfortunately, the Qs went all the way down below their opening range and below the prior day's low to close pretty much on the lows of the day. So that's what the market did. What we're going to talk about today is how do you find stocks that really have true strength in them, all right? Stocks that are going to be strong even in a market that may not be strong. Now, today wasn't a bad day, right? The SPYs were up marginally, and the Qs were down 0.5%. So that's not so great, but not so bad, all right? On the other hand, I was looking at stocks that I think are going to be strong because they've got these triple play indicators telling me that they have strength in their trend. And so look at how these traded today. So the first one, I'm not going to tell you the symbol right now because later I'm going to go over certain symbols I'm watching right now for trades as a kind of a bonus for those of you who have attended this live. Some of these will be on it and some of them will not. So this one, and some of them I also have, in fact, every single one of these I now have live trade in. So we'll talk about those later as well. So this one consolidated like the markets, broke its opening range like the markets, but when the markets went down, this thing went its own way, up. That's what I mean by leadership. This is a leader on the upside, okay? Now, this one had a strong straight up rally, no real consolidation, just went straight up. Also took out the opening range high. It got pulled back by the market, right? But this was its low of the day. Never got close to it, even though the markets did. You can see the pattern here. This one followed the market up, but when the market went down back into its opening range, this one stayed up and consolidated. Nice consolidation. Looking forward to tomorrow on this one. And finally, this one, same story. It had a hard wanted to hold its opening range high, but came back into the range, but didn't break down to the low of the day. So the strong stocks didn't follow the market all the way down, and had the market bounced back, these things probably would have all rocketed like the one that just took off higher. So those are the kinds of stocks I'm looking to find. I want to show you in this presentation how to find stocks that are about to break out and run, or the opposite. When they break out, they're actually weaker. I just showed you what happens when they're strong, but when they're weak and the market gets weak, they get absolutely hammered. I want to show you how to find stocks that are perfect for buying or shorting on the retracements when they pull back to these major moving averages, so that you've got really low risk entries and you can get into explosive trends on pullbacks. And finally, and this is going to be perfect for these current market conditions, because if you can identify stocks that are basing and then they break out of those bases, they can run for months for huge gains. The market has just washed out so many, hundreds of stocks. Not all of them are going to snap back right away. They're going to take months to base out. But you know what? There are already stocks that have been basing out for months, and they've already started to take off. So in this webinar, you're going to learn 3 conditions that you need to know before buying or selling any stock to maximize its potential. These indicators are going to reflect that. They're going to make it easy for you to do that. I'm also going to show you which stocks are at the greatest risk of collapsing even if the market continues to go higher. I just gave you a hint at that because we're going to find these underlying true trends that may not be the same as what the price action is. And we're going to find the stocks that have the greatest potential to break out and continue to run. We're going to find the leaders in a stock, in the market. All right, and we're going to find the best setup for simple but explosive trades, which is perfect for options, right? But clearly it works good for stocks too. So a question comes up, is this only for stocks? I am going to focus on stocks. It does work on ETFs. But if you're trading Forex, this isn't really going to apply. If you're trading futures, it isn't really going to apply. But if you trade stocks or ETFs or options on these stocks or options on the ETFs, it will. And as I said just a few minutes ago, if you stick around, the educational part of this is about 45 minutes. And after that, I really appreciate you guys coming to see this live. I'm going to talk about trades that are set up based on these indicators right now. This is for the live presentation only. So Raleigh did a great job of introducing me, so I'm going to skip that slide when I get to it. But before I get into how to identify the trends, first, let me just take a step back for 1 minute and explain MarketGauge. MarketGauge was founded in 1997 while my partner and I were at a multi-billion-dollar hedge fund called Millennium Partners. It was a quant-based hedge fund. We were focused on using neural networks to identify trading opportunities. While we were doing that, we developed tools. It became obvious that other traders wanted the same tools we did, and we were able to found MarketGauge in order to distribute those analytics to professionals. That's how we started. Distributed to the likes of Fidelity, Bank of America, Townsend Analytics. We were on Barron's for a long time. And from there, we branched out, formed MarketGauge.com, and have been providing education and trading ideas and systems to active individual traders for years. So I've been doing this since 1990. That's a quick picture of me. Been doing it for 25 years. I was fortunate enough to have a mentor, my partner, Keith Schneider, who was about 10 years older than me. And I've worked with him ever since. So it's kind of a unique company in that respect too. So I hinted at this earlier too. Why now? Why this particular set of indicators right now? Well, I probably don't have to explain to you that the market's changed, right? It collapsed in what seemed like almost a matter of days, almost from out of nowhere. But it wasn't from out of nowhere. We'd spent a year consolidating. And when it broke down from a weak point, all right? The internals of the market were weak, and it just totally got flushed out. As a result of this, it's not going to take much for this market to have another 10 to 20% move by the year end. In fact, if it goes back down to the lows of last week, it will be a 10% move. It goes to high, it will be a 10% move. All right, so if we get anything more than that, it could easily go 20%. It's not often you can look at the market and say, you know what, between now and the next 3 months, we could easily see a 10 to 20% move. But that is definitely the case now. Now, what I'm going to show you in this particular webinar works in any market, but it just makes it even more critical right now. I don't want you to get surprised or crushed by being in the wrong stock at the wrong time ever. But right now, the risk of that is even higher. And also, I was glad to hear that most of you aren't in this situation, but volatility is an opportunity when you know how to trade it and you have a good system for identifying the right places to be. If you're afraid to trade until it's safe, you'll never trade. And by the time it's safe, it's too late. Right? So you need a systematic way to identify the right places to be, low risk trades, so that when the market's volatile, you can keep your risk low and you can enjoy the volatility when you're right. All right? And that's what I mean when I say you have to learn how to make volatility profitable and not the reason that you miss trades. So the 3 conditions you should know. I'm going to go through these really quickly, and then I'll dig into them in more detail one at a time. The first one is leadership. When you look at your trade, do you know whether or not there's a real underlying trend behind your trade? Are you trading something that's actually leading the market or something that's just whipping around with whatever the market's doing? The second thing is volatility. When I say volatility, I mean you want to know where within a stock's volatility range your trade sits. Are you at an overbought area, an oversold area? Are you in a compressed area? In other words, is your stock somewhere where it's in a good position to actually move? And finally, you want to know what the volume situation is. Volume is incredibly powerful if you analyze it in a simple way. If you overanalyze it, all it will do is confuse you. Now, if you take all these 3 things and combine them with some simple patterns, you'll be in the right place for huge profits. All right, in other words, leadership, volatility, and volume, put all these things together, you can grab great profits out of the market, and that's why I call this presentation Triple Play Trades. So let's look at leadership. 70% or more of a stock's move is just following the market. All right, there's the market's going to do what it's going to do, and most stocks just follow it. So if you're not trading a leader, then you're just going to get whipped around by the market. You might as well just trade the market. All right, but if you trade a leader, then you can get what you saw in my charts earlier today. You can get a day where the market sells off or has a blah day, and your positions still make money or lose less, and you're able to hold on to them longer, and then you get these positions that just seem like they just keep going up even though the market's not doing much. All right. So the other thing about trading leaders is that when you can really identify a leader, those are the ones that when they get pulled down by the market are going to be the ones that you want to focus on, because as soon as the market either stabilizes or recovers and starts to move higher, they're the ones that are going to take off, which is exactly why the pullback or the collapse or the plunge, whatever you want to call it, in the market right now is such a huge opportunity. All right. Leaders have the best moves after market sell-offs. Market sell-offs enable you to identify the new market leaders, and sometimes, very often in fact, they actually define the new market leaders. All right. Now, new market leaders or market leaders are often referred to as relative strength investing. All right. Now, I may be trading for 25 years, but I certainly don't have the same name out there as many other professionals. So take James O'Shaughnessy, for example. This guy literally wrote the book, What Works on Wall Street. And for any of you who are not familiar with this book, if you like a 600-page book that pretty much goes through, I don't know, 50 different possible trading strategies with exhaustive data mining and testing, reams and reams of data and statistics, you'll love this book. If you don't really want to do all that work, I'll summarize what he has to say. Relative strength investing, buying the leaders, is one of the best performing systems that he came up with out of all the systems that he tested, including value, including many different momentum models. And in the end, he summarizes it with these quotes. And I'll start with the second one. Over 6 to 12-month periods, winners generally tend to continue to win, and losers generally continue to lose. Right? It's a really simple concept. The problem is that the test he did, that was the system that was the best system, he himself even said that no one could really trade it because you had to have way too much capital to invest in all the different stocks, and the drawdowns were so huge, most people wouldn't stick with it. Right? That said, the conclusion was still that if you can identify the leaders, they continue to win, and the losers continue to lose. So, the thing that makes these indicators so exciting to me is because it answers this question. How can you get this type of an edge while trading individual stocks? How can you pull up an individual stock and just know whether or not it's a leader or it's lagging? How can you know if it's got good volume or volatility? That's why we came up with these indicators. Let me just show you how it works before I get into any details. It really is this simple. I'm going to see if I can change the color of my pen here. Okay. All right. So here's an example of one of the indicators. One of the indicators I'm going to call price leadership. Now, the idea of reading this indicator is you've got the blue line is a shorter time frame, a red line is a longer time frame, and the black line is an even longer time frame. All right. And the blue line represents whether or not the stock is exhibiting leadership or not. So if it's trending higher, it's exhibiting leadership. If it's trending lower, it's doing the opposite. So on a big picture here, you could see IBM over a long period of time, over well over a year. You could either categorize this as kind of a slowly rising base, or here's the 200-day moving average, this black line. It's generally moving up with 200-day moving average, this black line. It's generally moving up with its swing highs, swing lows becoming lower and lower, and its highs becoming higher and higher. However, when you get to this high, and it's been going on for a year, and take a look at this chart, you can see that underneath what looks like something that's either range bound or making progress, it's actually declining. Right? Now, reading these indicators is as simple as looking for the blue line to be under the red, and even worse, the red line under the black, as we have in here, and that's bearish. So down here, this indicator is telling you, one, it's bearish in the short term. It's been getting worse over time, and yet the price action would have you believing that this thing looks pretty darn good. All right, so this is an example of what I described coming into this as the true trend here is that this thing may be doing whatever it's doing in price action, but underneath it all, it's really deteriorating in terms of price. Now, there are several different patterns that I'm going to show you as we go through this. That's just one. If we look at another example in a shorter term time frame, you've got a completely different stock here. Looks like it's in a good trend based on the 200-day moving average here. And actually, this looks like pretty good consolidation that could lead to a significant breakout. But as it's consolidating in here, your leadership line is breaking down. Now, the way you read this is if it starts to break down in price, you want to get out of the way here. All right. When I said earlier, identify stocks that could collapse even if the market's going up, this is the kind of thing that that keeps you from getting crushed in stocks that go from being strong to getting crushed. This is not a small move here. Even if the breakdown began just over 80, down to 65, $15 on an $80 stock, it's almost 20%. All right, it's ugly. And you had a really easy warning right there. All right, so that's what I mean by avoiding dangerous stocks. And reading these indicators is that straightforward. We'll talk about stuff that's bouncing and moving up too, but you can see when it goes back positive and the market comes back over the 200-day moving average, starts to head higher. Now, I'm kind of jumping ahead here, but when this thing got back down to the 200-day moving average, and granted, you've only been listening to me for a few minutes now, comes down, looks like it has somewhat of a positive pattern on the 200-day moving average. Now that you know what you know about these indicators, do you think that's the bounce you want to try and buy? No, right. You don't want to buy that bounce when the indicators look that negative. Same basic price location, when it comes back over the 200-day, you've got a completely different picture, don't you? All right. So when a market breaks out, the price action may look great. It might even pull back to the breakout. That's fine. But if it does, and your leadership isn't there, you want to get out of the way, right? When it's in a consolidation area and it breaks down through that consolidation, you don't want your price leadership line to be negative, all right? And sometimes it can take months for stocks to consolidate. This is what's going to happen going forward from where we are right now. It happens all the time. It's just like we had a breakdown in this particular stock. It took a long time for it to consolidate. So while so many traders could have easily been looking at all these rallies as, oh, this is the one. Oh, this is the consolidation here. Oh, this is the one. When it finally breaks, look at how far over the blue is over the red, all right? If you get nice separation, it will look obvious and you will get really nice breakouts, all right? So when I say breakouts that you can trust, that's what we're looking for. Does this make sense? Pretty straightforward, right? Now let's take a look at volume. One of the early things I learned or was told was volume precedes price. That's true sometimes. When it happens, that's great. It's a great heads up. But always make sure that you use volume as a confirmation. Everything that we do with these indicators is confirmation. We're looking for price patterns, and those price patterns, there are many of them. But even if you were just focused on stocks that are retracing to major moving averages or crossing back over the major moving averages to reassert the major trend and use these indicators to confirm whether or not the price action you're seeing is really true, that's all you need. All right, but volume is incredibly powerful when you can actually use it. Just don't use it by itself. So here's an example of the volume indicator. You might be thinking, well, that looks just like the price indicator. It does. You read it exactly the same way. We've set it up so that all you have to do is look for the blue line over the red line, good separation, good direction. So here's Regeneron. Consolidating for months, right? Consolidating for months. If it moves up to the high end of that consolidation, do you want to jump on it? Do you want to anticipate that this breakout is going to continue? Well, if you don't have any volume, then you got to be careful. In this case, you can see the volume actually broke out before the price, but you still want to wait for the price. Now, if you were trying to figure all this out by looking at the volume bars here, there's no way. You drive yourself nuts. Is the volume actually trending higher there? Does it seem like the markets is more in an accumulation mode than distribution mode? Look, if you can go through bar by bar and figure that out, all the more power to you. I'd rather just be able to look at something that is over a line and moving higher and know instantly, okay, if this breaks out from here, this is one I want to follow based on volume. All right. So once you know how to read one, you know how to read them both. And if you can find the volume, as I said before, moving earlier, even better, because it gives you a heads up. And oftentimes, the volume moving earlier happens at bases. Why? Because bases are a time where you wind up getting strong holders who are willing to accumulate a position, and they're patient. They're not trying to run up the stock. They just want to accumulate their position at lower prices. And in doing that, they create a situation where volume becomes the leader, not price. Now, it doesn't happen in every base, but when you see a pattern, and one of the stocks I'm gonna show you later that I'm just waiting for to break out right now is exactly this pattern. In fact, two of them might be. Volume broke out and started showing positive signs right here. All right, but now you have the price indicator up here and the volume indicator right here. Now you want to see both. All right, so when the price finally gets going here and the price itself breaks out, then you've got a breakout that you know you want to focus on. And when you've got a breakout that you can focus on, these are the ones you don't necessarily have to chase if they move higher. You know that when they pull back into these levels, those are the ones you want to focus on. All right, when it moves higher, then pulls back, those are the ones you can focus on. All right, sometimes you catch them where you wind up getting it here, and as you can see, several months of a really big move. The whole move, the price and the volume stay in gear. If they had rolled over at the 200-day moving average, then it probably would have been the end. Right? But that's how straightforward it is, and it makes it really easy to put it together. Wouldn't you agree that in interpreting these indicators, I don't know if we could have made it much easier. There is one other trick in terms of knowing how far above the red line you should be. But even if you don't do that, you know a good spread above the red line is what you're looking for. All right. So here's just another example. This happens to be Apple. I remember this one well because I actually bought it. I was feeling a little nervous having to buy it all the way up here because I'd been watching it through this whole period and naturally would have preferred to have buy it down there, but it didn't really confirm until it was breaking out here. It was a really nice run though, right? And as you can see, when it started to break down here, these things were telling you needed to watch out below. As it turns out, didn't collapse completely, but it's still 10% move there, probably almost 10% move there, and you wind up getting a really strong signal right as it starts to move again. All right, so if you put it together, it's really straightforward, not that difficult. All right, so now the third thing you should know about your trade. Now you know when the price is right, you know when the volume's going your way. What about volatility? Now, honestly, volatility is kind of like volume. If you pay too much attention to it, it can drive you crazy. I think it's really important to have some perspective as to whether or not your stock is compressing or extended. I picked a really basic indicator to give you a sense of this, but I don't want you to overanalyze the indicator. The indicator is a simple Bollinger Band, okay? Now I know there's a lot of systems that you can build around a Bollinger Band. the Bollinger Band here is really just used as a visual and maybe to some extent kind of a mathematical cue that you're on the right track. And a couple of ways that you can use it that are just really straightforward is to understand whether or not the market is compressing or whether or not it's been expanding. And if it's compressing, those are going to be the better breakouts. So if you've got a compressed market, when I say compress, you just look at the Bollinger Band and is it getting really narrow? Is it really narrow? It's compressed. If you see that and then you see a situation like you see here where throughout this whole compression, what's happening to the underlying trend? It's getting weaker. So if this breaks out to the upside, that's a breakout that's probably going to fail. Now, does that mean you sell it up here? No, it means you wait for a sign that it has reversed on price, and then you anticipate that it's going to just come right back through the compression and continue lower. In this case, it didn't even try to break out, not surprising with how weak it is. It just broke down. And that's a breakdown you either want to get out of the way if for some reason you're long, or it's a short opportunity. Right? Here again, it starts to compress and it breaks down through the bottom of the Bollinger Band, but more importantly, through the bottom of the price range. And when it does that, comes down to the 200. Are you going to look to be a buyer at the 200 knowing what you now know? No. And on down it goes. All right. So as you can see, I'm not saying, we're not using the Bollinger Band to say, okay, it's hit the Bollinger Band here, it's hit the Bollinger Band here, it's time to reverse. No. Is it compressed? Is it extended? On a breakout, one of the helpful visuals of a Bollinger Band would be that it breaks the Bollinger Band and then reverses. Now, if it does this and you've got bullish indicators below, that's interesting, right? But that's not what we want. We're looking for the opposite. We would look something more like this, breaks the Bollinger Band and comes back in. But that's not, didn't really break outside of it enough for me to have been flagged. This one, on the other hand, you might say hits the Bollinger Band, really collapses, everything's turning negative. This looks terrible. Make sense? All right, so another example of divergence would be the Apple trade that we just looked at. All right, so Apple really compressed, breaks down through the Bollinger Band. The volume breaks down, but the price doesn't. All right, so this was one of the things that made this even more compelling that I talked about just a few minutes ago. These were all in alignment, plus you had the divergence on the Bollinger Band. All right, so understanding your volatility, and as you can see, on one hand of the volatility, we're looking at it and saying, this isn't right. I don't want to be a seller here. On the other side of it, we're saying, I know that it's extended, but it's going to continue, right? So the volatility is used in a simplistic and specific way. If you know all these things, then you're going to avoid a situation where you're buying something that's extended that doesn't have price or volume really supporting it, all right? Or you could be buying something that is extended to the downside that does have price and volume supporting it, all right? So it gives you a healthy perspective, and it can be applied to just about every pattern out there. So someone saying no interest at that price level, this is bullish, isn't it? I think if you're referring to this being no interest, then yeah, it gets to the outside of its volatility zone, which should mean it should snap and break down. And push, which should mean it should snap and break down. And it probably even did it on a large volume, but it didn't. It snapped right back. And not only that, it demonstrated leadership when it snapped right back. All right. Someone's asking what these lines below here are. That's just another chart that I have scrunched there that wasn't relevant to the presentation. I think that's what your question is. All right, so let's just review quickly. What you want to do, look, and whether you have these indicators or not, these are three things you need to pay attention to in all your trades, right? You want to know, is your trade a leader? And a leader can be a leader on the downside as well as the upside, right? I tend to look more towards the upside because the upside is almost limitless. The downside always has a floor. You could argue that the downside happens quicker, and that's why you like the downside. There's plenty of reasons to like the downside for sure, but let's face it, the market has spent about 90% of its time going up and 10% of its time going down. I'd rather throw the darts at the 90%. Every once in a while, I'll definitely go to the short side, but I spend more time making sure I don't get caught by the shorts than focusing on it. That's the only reason the presentation focuses on more so on the longs. But it's just important to know this for both longs, shorts, and protecting your longs. All right. So if you have a leader that's leading the market on the way down, same thing applies. But what you need to know are the three conditions: leadership, volume trend, and where are you in the volatility picture. All right. If your stock has one or two, it's at risk of failing its trend or failing the pattern. All right. If it's missing one or two of these, it's at higher risk, especially if those one or two are the price of the volume. All right. So the best trades are really simply where you've got all these three working together. So I said earlier, this works for options. It works for options if you're a directional options player, right? If you're looking for stocks that are about to explode one way or the other, right? It's not exactly for selling premium and hoping the stock does nothing. Here's an example. Just a couple weeks ago, this is a recent example. So during the whole debacle of the market, look at what this stock did. All right, and I actually put this out publicly just the week after when the market collapsed. I put this stock out and said, look, these triple play indicators here are saying that this stock, if it breaks the 200-day moving average here, you got to be paying attention to this thing. And so look at how this has worked based on what I've just shown you, right? Tries to break the, hold on, got the wrong pen, sorry. It tries to break the 200 here, but when it pulls back, the indicators fall back, all right? Once they fall back, this thing tries again, but the indicators are not in gear, all right? This is the 50-day moving average. So even when it gets above the 50-day moving average, still needs to get above the 200 just because it's right there. And here, trying to break out, price never goes, and it falls back. Now, had the price moved here and the price indicator and the volume indicator turned up, that would have been a good time. I was watching it there, thought it might happen, but it didn't. Okay. Now the market gets clocked, and this thing comes right back to that 200-day. But this time, look at where the indicators are. Right? It's not like you're trying to figure out if it's just a little bit above it here, or a little bit above it here. They have already exploded higher. Right? And so this might even be as of today. In the last several days, as the market has gyrated around, this thing's moved up over 10% relentlessly. Okay? All right? Relentlessly. That's the kind of patterns that we are going to see for the months coming forward. Really simple patterns. All right? Which stocks are moving back over major resistance areas? Those are the ones that are going to become the leaders. There are going to be hundreds of them. How you're going to sort between one and the next one, I don't know. Well, I know how I'm going to do it. All right. That's what I love about these indicators. So here's another example of the kinds of patterns that we're going to see going forward. Happens to be Tesla. Tesla's a good example because it's been a really volatile stock over time. So here's a similar example to where a lot of stocks are now. Breaks down through the 200, rallies back up. Should you be looking to buy it through the 200? Or in this case, maybe you're looking to see if this is one that you should short on the rollover. Well, when it starts to roll over, look at where your indicators are. Negative. When it's approaching the 200, it's not really all that positive. So all you have to do is identify the key short-term levels there, and then look to see if you should play it from the long side or the short side. Here's an example of breaking above the 50. Looks like it might be flagging, but what's flagging is its strength. It's just getting worse. And then when it comes back up there the second time, it's even weaker. Okay? So there's going to be plenty of stocks that are trying to get over the 50-day. They're going to be your favorite names. But if they don't have this underlying strength to them, don't take the chance. Because look what happens when it all comes together. Here's, again, finally breaks over the 50. Doesn't look much different here than it did here or here, except this is completely different. And then this flagging action, you're sitting here watching this the whole time, saying, you know what, as soon as this flagging action shows me some more action on price. And this is kind of where I would get into the option positions, right? Where you can limit your risk. Then maybe you're buying it on the dips because it is Tesla, it's volatile. Buying it on the dips, got limited risk, and you're not necessarily waiting for the pop. But when you get the pop, you know that's the pop to follow, right? And here is another pattern you're going to see hundreds of times. Stocks are going to consolidate around a 200-day moving average. It's going to be flat or down. Should you follow it to the upside or the downside? This one, you want to follow it to the upside, right? Doesn't mean it can't come down, but you can go find one that looks like this here to follow on the downside. All right, so there are a lot of different ways you can use these three components and use these three indicators. I'm showing you the simple ones that apply directly to what the general market is set up for right now through the end of the year. It doesn't mean it's only going to happen from now through the end of the year, right? Markets are constantly going through cycles. But we have not seen a correction this severe in since 2011. So it may go down some more. If it does, I'm thrilled because the further it goes down, the better the next move up will be. But if it doesn't go down anymore, there's stocks already setting up now. And I'm going to show you a handful of them in just a minute. But there's, like I said, there's a number of different ways you can use these indicators. But if all you did was use them in this simplistic way, you'd be just fine. But we do have a course that will show you a lot more setups than what I've shown you, and much more specific setups than what I've shown you. It's about 3 hours of streaming video. So all you'll have to do is log onto the website and log in, and you'll have the course in front of you. Access to it is lifetime. And with the course, you'll get 6 really specific trade setups, including your entries and your exits. I've been talking in general about buying through ranges, buying below support or resistance. All those levels are defined in a way that are set up like trade setups that all have names like high volatility reversal, breakout failures. You'll know the best breakout trades to take, the squeeze trades, an ambush high trade, head fake low trade. It's all covered in these streaming video modules. So if you take advantage of this special offer, which we call the triple play advantage, you will learn how to minimize your risk. I think you can see how we're going to minimize risk, right? Based on specific price points that you're going to trade against. You can see that we're going to identify specific patterns, and not only for daily, but for intraday if you want to use this on intraday, all right? And you'll have rules for all of the setups for both the indicators and the price action. Now, the course alone has a value of $497. Now, that's lifetime access to streaming videos. Now, of course, you're also going to need or want the indicators. So the indicators, we could easily sell them for $497 on their own. All right. Now, you do need to have certain platforms in order for this to work. The beauty of these is that they are very simple to calculate. So if you have a platform that enables you to customize indicators, you'll be able to do this. But if you have Thinkorswim, TradeStation, NinjaTrader, TC2000, Metastock, eSignal, Trade Navigator, and all those, we definitely know it works just fine. Plus, we give you the formulas. So if you have like I said, if you have a platform that you can customize indicators, put in your own formulas to customize how the line is calculated, you'll have everything you need to do it. You'll have the formulas, you can apply it to more than one platform if you have one platform. So you'll get the course on how to trade them with the patterns. You'll get the indicators that I've just shown you here. And then I've got a bonus. And the bonus is that we've recently developed scanning software that scans the markets for the top 25 bullish and bearish setups, patterns. Every week, I put out a mentoring video. That mentoring video takes several stocks from that list and walks you through how I would trade them, why I like this particular setup, how I would interpret the triple play indicators. It's like having me there for 20 minutes, 10 to 20 minutes every Monday in a video showing you stocks that I'm looking at, not just for Tuesday, but for the week. Sometimes they're worth keeping your eye on for much longer than the week. As that stock I showed you earlier was one of those stocks that broke out through the 200 and just kept going. The stocks that I said I was trading today were stocks that I covered in that video on Monday. So I'm not just putting this out there to fill my time on a Monday evening. I'm using this stuff, all right, and I'm sharing it with you. Every day you'll be able to have the scan of the 25, and you'll be able to see the 25 stocks that have shown up for the last each of the last 5 days. So you'll have plenty of ideas on your own, plus that mentoring. That subscription service is $97 a month, which gives it $1,164 value. Add all that up, and this is a $2,158 value. But this is a special offer. I really appreciate TradingPub for giving me the opportunity to present to you guys. So you'll get lifetime access to the course, lifetime access to the indicators, and the bonus full year of daily alerts and weekly mentoring videos, all for $497, one payment. All you have to do is go to marketgauge.com/triple. And I think Jana's just put that in the text. And you'll get even more details about what's included in each one of these levels. So I gave you a quick description of it right here, but Marketgauge, and Gauge is G-A-U-G-E. It's often misspelled. So if you type it in and the page doesn't come up, you probably misspelled Gauge. Don't feel bad. I still do it, and I've been writing it since 1997. So marketgauge.com/triple special offer. It is limited time, so please take advantage of it right now. I'm going to answer any questions that people have for a few minutes, and then I'm going to go to my live charts, and we can look at I think I've got 5 stocks I'm going to go over with you that I think you should be watching right now because they're set up beautifully on the triple play. And like I said, I'm in them. In many cases, I'm already in them. There are 5 of them, and with the current market conditions, I have whittled down the number of my positions. So I'm looking at the list right now. I am in 3 of the 5. All right. So again, this isn't just, hey, here's some stuff. Oh, and by the way, I just got in them today. So when I say they're fresh, they are fresh. And it is a bonus for you for attending. I really appreciate you taking the time out today. So, questions. Is a course in U.S. dollars or Canadian? When you go to purchase, you'll be paying in U.S. dollars. I'm not sure if that answers your question or not. Do you think the S&P will get down 15% around the support before resuming the uptrend? You know what I think? I put the odds at 50-50. And I rather than wait or try to guess, this is how I trade it. And I started the presentation this way. There are certain levels the market needs to break in order for me to start nibbling. Now today we kind of broke the 10-day and looked like we were going to confirm with the market, so I got into some positions. If the market moves down, I'll most likely get stopped out. If it goes all the way down to the lows, I'm sure I'll get stopped out. If it goes down to the lows, I will look to see how it reacts to the lows. If it bounces off those lows, and this is part of the mentoring video. Every Monday, the first thing I do is say, all right, here we are in the market. Here are the key levels. I want to have a either bullish bias until the market breaks this level, bearish bias till the market breaks this level, or neutral till the markets break these levels. And with that, I will have either more positions on or less positions or bigger positions or smaller positions based on that bias. So right now, do I think it's going to go down? I think there's a high degree that I think there's at least a 50-50 probability that we do retest the lows. I think secretly, I hope we do, because it'll be a lot easier to trade from the long side if we do. However, if the market starts building momentum on the upside, I will get more and more bullish as it starts to break through those levels. Now, some of you might be looking at that or thinking, well, that's crazy. Why would you get more and more bullish? Well, because if this thing takes off, or if this thing starts to move higher, it could just really take off, or it could just continue to grind higher, take out the highs with everybody saying this can't happen, this can't happen. Everybody be kicking and screaming, and you will have missed the whole move. All the while, it's not hard to see when the market's going to roll over. With these indicators, I will know it. Look, if the market continues to take off, I'm sure some of my longs will start to roll over and the market will continue to go higher. I'll get out of them, I'll get into new ones. So I know that's a long explanation, and now you know why I don't answer questions in the middle of the presentation. The idea for me isn't to try and figure out where it's going to go so I can get in. The idea for me is to figure out how good is the opportunity that I have when it breaks the numbers that we're close to. It's breaking some numbers now. They're not really big numbers yet, so I'll have smaller positions. I am more, so you've certainly been long. I have definitely been more long than short, and the reason for that is because the drop came in 3 days. So I did not, well, I did say we could have a big drop if we broke. My warning to members was get out of the way. I was never one to say get aggressively short, and that is really because it came so abruptly. I could see that it could happen, but I wasn't willing to bet big on the short side. So definitely, I've been on the long side, but you know what? It's paid off. It's been much easier to be long. So put it this way, I missed those 3 days. I was not short, but I didn't get hurt either. I missed 3 days. If I was trying to catch those 3 days, I would get chopped to bits. That's my style. It works for me much better. And then I caught some good moves on the VIX afterwards. So, and you know what? I don't even want to say. I just missed it on the VIX. The VIX is the way I wanted to play it, but I just missed it. They are available on TC2000. You need to create them on TC2000. We give you the instructions to do that. So as soon as you become a member, there's a page to do that. So as soon as you become a member, there's a page in the member area that gives you the instructions, gives you the formulas. So we know that, off the top of my head, I don't know if we have a file that imports on TC2000, but I'm pretty sure we had a TC2000 member give us what we have. I know that in terms of how long the offer will be, I know that the video will only be up through the weekend. We take people in classes. It makes it a lot easier for us to manage customer support issues. We're not a big operation. We've got 3 partners who all trade. Then we've got 2 other traders who help us with trading and research. We've got Mary, who is on live chat. So you can, if you go to that page, marketgauge.com/triple, you can get her on live chat with questions. And then we've got a couple of tech guys. So it's not like we have banks and banks of people here. We're traders. So because of that, we open up different systems in classes and then close them and then move on. And Mary's telling me she just looked at the site. TC2000 has the instructions to download. All right. What account size do you need? All right, so you can do this with any account size because it's really all about finding the best opportunity for, I've portrayed this as finding good swing trades that last days, weeks, maybe months. The truth is, part of the course will also show you setups for intraday action, and you can use it for day trading or timing your way in intraday as well. So you don't need to be a day trader, have a day trading account to do this. You don't need to trade huge size because you're going to look for big trends. You can trade it with an options account because wouldn't you agree that if you trade options and you could find the day or the breakout or the retracement that is the right one to put on your options position, you could do it? That's why you can do this with any account size. Are there any other monthly fees? No, there aren't any other monthly fees. And if you sign up now, you're going to get a full year of the alerts. And because you will be coming from a kind of an annual, you will get a special offer at the end of that year. So you will not have to pay $97 a month if you decide to continue. I don't know what it will be because it's all new, but it will not be more than that. Because once you're grandfathered into a price with us, we don't raise your prices. How, Bob, you're asking me, how do you rate them into ORs? I'm not sure. I don't understand your understand your question, Bob S. How is it possible to set up scans? We give you the formulas for the indicators. So, and we don't do this for all of our stuff, but we do it for these. So, can you set up scans would totally depend on your software. Look, if you have TradeStation, you could figure it out how to do it in Radar. No doubt, we do. I know someone else who's done it too. I'm not familiar enough with the other platforms to know how you can do them. How do you create them in Thinkorswim? I think you just import, what's the name of the file in Thinkorswim? Um, it's a file import, I believe. All right, are there any other questions? Does it work on ETFs? It will work. Look, it works great on sector ETFs. All right. If you go into these really obscure ETFs, then not so much. But if you can relate the ETF to the overall market, then it will work. Like I said, I don't want anyone to try to apply this to currencies. I don't want anybody to try and apply that. I mean, conceptually, I do believe it will work in currencies, but we don't have the indicators, and it's not being. We don't have it all set up for currencies. Wouldn't be straightforward to set it up. So I don't want anybody to be disappointed there. If you're trading E-minis, this really isn't what you need. Again, I don't want anybody to be disappointed. If you're trading stocks or sector type ETFs, this is exactly what you need. All right. I use it primarily for stocks. It's an assist for ETFs. The only reason I say assist is because volume in ETFs, I give volume in ETFs less credibility than I give volume in stocks, right? So the indicator is only going to be as good as the underlying data. So volume analysis in ETFs is, to me, not as reliable as it is in individual stocks. If you think that it's just as good in ETFs, then great. But I definitely use it for the leadership, and if the volume's there, great in ETFs also. But stocks kills it. All right, stocks are really where it's at. So, any other questions? I am going to I want to take a look at some positions or some trades that are set up right now for you guys. But again, get to marketgauge.com/triple, and as soon as you register, you will have immediate access. You will get a welcome email that will explain everything that you need, but really all you need to do is then go to the My Market Gauge on our main homepage, which will say in the email, and you'll see what you're entitled to listed there. And you could be up and running by tomorrow. By the end of the weekend, you could have been completely through the course, and you will have the scans. You'll have a list of stocks to be focused on come Monday. I mean, actually, you'll have a list of stocks to be focused on tomorrow. I'm not so sure that Friday after a jobs number into a long weekend is the best time to be positioned. I took small positions today only with the anticipation that if tomorrow happens to be a good up day, then I'll be in a good spot. Won't have to chase it tomorrow, right? But literally, you can be ready to go the next day because all you're going to have to do is log into the site and start watching the course. And for I think the question, if I were you, the question I would ask is, what's it worth to be able to have this kind of insight into the direction of a stock? How much is it worth to avoid one of those bad trades or two of those bad trades simply because you now know that what looked like a strong stock or looked like a weak stock really wasn't? And so when it reversed, you would be quicker to get out. Or how much is it worth to be able to whittle down the number of candidates that you're looking at based on ones that have true momentum and price and volume. Like I said, there are going to be so many opportunities if this market starts to head higher. There are going to be too many opportunities, and it's going to be very difficult to figure out which ones to take. All you have to do is pull up a chart. You'll immediately see whether you've got price and volume. Plus, you'll have the volatility on there. I didn't have the volatility on most of the charts because I wanted to keep it simple. The course will explain how to look at the volatility. But really, if you kept it as simple as I presented it today, you will be way ahead. So if look, if you're killing it with what you're currently doing, I'm never an advocate of more stuff on top of something that works. But if you want to, if you have room for improvement in what you're doing, um, this, as I've have said in messaging in the past, is these two indicators. This view that I've shared with you of the markets is one of my go-to views that I look at for stocks. Just like I will always look at where the 50 and the 200-day moving average are, I want to know what my triple play indicators look like. All right, so marketgauge.com/triple